Truist completely crushed consensus this morning. We are looking at Q2 2026 revenue of $5.31 billion, and diluted EPS came in at $1.23, which is, a massive 37% jump year over year.
Right, and their guidance is just as aggressive. They're projecting full-year revenue growth of 3.5 to 4%, while capping expense growth at a very strict 1.75%. So unsurprisingly, the stock is catching a serious bid today, rallying hard on the open.
Yeah, shares popped immediately. So welcome to today's deep dive into these Truist numbers. Because our mission today is to figure out what this regional giant's massive quarter tells us beyond just the balance sheet. We really want to decode what this reveals about the broader economy, the sort of hidden digital transformation in banking, and obviously a sudden transition of power at the top.
Exactly. Imagine a business that brings in over $5 billion in revenue in just 3 months, relies on hundreds of millions of AI-generated consumer insights, returns more than 100% of its earnings to its shareholders, and then right in the middle of all this, quietly announces a new CEO.
It's wild.
It really is. This earnings report isn't just a scorecard. It's actually a pretty incredible window into the health of both Main Street consumers and Wall Street dealmakers at the exact same time.
Okay, so let's unpack this right away. Before we can understand the tech or the new boss, we have to look at the financial engine making it all possible. Net income available to common shareholders hit $1.52 billion. But the company returned $1.8 billion to shareholders in Q2 alone.
Right.
That's a 52-cent per share dividend and $1.2 billion in share repurchases. So they are returning 121% of their earnings.
I got to push back on this because it's like a bakery selling out of bread for the day and then giving the customers the cash from the register plus money out of the owner's own wallet.
Yeah, it sounds crazy when you put it like that.
Right. Like, is it actually sustainable for a company to return more than it earns in a single quarter?
Well, on the surface, it sounds reckless. But you have to look at the why in the source data, specifically their CET1 ratio.
A common equity tier 1. Yep.
Exactly. The CET1 ratio actually improved to 10.9% this quarter. They aren't going broke. They are just efficiently managing their capital through what management calls balance sheet optimization.
Meaning what exactly? Like just dumping bad loans?
Basically, yeah. It's about reducing risk-weighted assets. They are shedding assets that require them to hold a ton of capital in reserve, which frees up cash. So by shrinking the denominator, the risk-weighted assets, their overall ratio goes up.
So they're legally and safely able to distribute that excess cash back to the shareholders.
Precisely. They are so confident in this optimization that they're still targeting a massive $5 billion in repurchases for the entirety of 2026.
Okay, wow. So now that we see how much cash they are generating and returning, where exactly is this money coming from? Because let's split the bank in half for a second.
Sure.
You've got the consumer side and the wholesale side. Consumer and small business banking pulled in $835 million in net income, and that's fueled by $405 billion in average total deposits, which actually grew by $5.9 billion this quarter. All right, the Main Street engine is humming.
But then you look at wholesale banking. They generated $960 million in net income. And the number that jumped out to me was investment banking and trading income. It was up an absolute staggering 72% year over year to $352 million.
That's a huge jump.
So question for you. With investment banking jumping 72%, is Truist secretly trying to pivot? Like, are they trying to become a mini Wall Street titan rather than a traditional regional lender?
Well, no, it's not really a pivot away from their roots. It's a synthesis. They are heavily focused on advisory revenue now, which was actually up 27% in the first half of 2026.
Advisory meaning like mergers and acquisitions.
Exactly. When they advise a mid-sized client on M&A, they collect a massive fee. But more importantly, they capitalize on the resulting liquidity. Truist brought in $11 billion in M&A-related client deposits just this quarter.
Wait, $11 billion just from M&A clients?
Yep. So it's a synergistic loop. That robust Main Street deposit growth we talked about, that provides this stable, cheap funding that allows them to play so aggressively in the high-margin wholesale space.
Oh, I see. So they get the fee and they get the deposits from the deal.
Exactly. It's a highly efficient model.
Okay, here's where it gets really interesting, though. You'd assume this level of deposit growth, managing $405 billion, requires building hundreds of new brick-and-mortar branches.
Right, the traditional model.
Yeah, marble floors, human tellers everywhere. But the sources reveal the real battlefield here is entirely digital. 71% of all their transactions are now digital. That's over 93 million transactions.
Seems a massive scale.
And it gets crazier. They have this AI chatbot, Truist Assist, which handled nearly 2 million chat requests, up 60% year over year. But the most staggering metric, Truist Insights generated 167 million personalized insights this quarter.
Yeah, that number is huge.
167 million, driving over 31 million client interactions. I mean, this sounds like a Silicon Valley tech company hiding inside a bank charter.
It really does operate like one.
But doesn't this run a risk? If you replace human tellers with an AI chatbot, don't you risk alienating your traditional, regional banking customers? Or is this just the absolute only way they can justify their rising expenses?
Well, it comes down to a concept called operating leverage. Yes, their non-interest expenses did go up 2.4%, hitting $3.06 billion.
Which is not a small amount of money.
No, it's a huge spend, and management explicitly said that was driven by investments in technology and talent. You can't build systems to generate 167 million insights on the cheap.
Right.
But those insights aren't just spam. They are personalized nudges about cash flow, duplicate charges, or higher-yielding accounts. So those 31 million interactions mean they are serving the client way more efficiently.
So they're basically doing proactive customer retention algorithmically.
Exactly. This isn't just about cost-cutting by firing tellers. It's about scaling up the relationship digitally. The revenue protected and generated by these systems outweighs the cost of the servers. That's operating leverage.
Okay, that makes sense. But with all this tech constantly analyzing customer behavior, what is Truist actually seeing in the real economy?
That's the million-dollar question.
Right, because if you turn on the news, it's all recession anxieties, consumer debt panic, inflation fears. But their provision for credit losses actually dropped 17.5% from the previous quarter, down to $395 million.
It's a very bullish signal.
And the net charge-off ratio, the NCO, fell 11 basis points to 0.50%. Non-performing assets even decreased by $37 million. Management is literally citing a stable economic and operating environment.
Yeah, you have the data to back it up, too.
So what does this tell you as a retail investor about the health of the average American consumer right now? Because it feels like a total paradox compared to the headlines.
What's fascinating here is their LL ratio, the allowance for loan and lease losses. Truist evaluates their massive loan portfolio incredibly rigorously, and they found credit quality to be so remarkably strong that they actually released reserves this quarter.
Wait, really? They freed up capital they were holding for bad loans?
Yeah, exactly. You don't release reserves if you think the consumer's about to default en masse. It's the ultimate vote of confidence.
Wow.
And this strong credit sets them up perfectly for what they call fixed-rate asset repricing.
Okay, what does that mean in plain English?
Basically, over the last few years, banks were stuck holding older loans issued at super low rates, like 3 or 4% back in 2021.
Right, the cheap money era.
Exactly. Well, as those old cheap loans naturally expire or get paid off, Truist is issuing new loans at today's much higher market rates. Because credit is stable and borrowers are paying them back, this constant rollover is expected to drive a 1 to 1.5% net interest income growth in 2026.
That is a brilliant position to be in, just organically widening your margins because the macro environment shifted.
Yeah, it's a very powerful tailwind.
Okay, so let's tie this all together. We have a stable economy, we have a highly advanced tech-forward strategy, and highly optimized capital. The ship is basically steering itself, but who is actually going to be steering it?
Right, the big news.
CEO Bill Rogers announced he is stepping down. He's handing the reins to Mike Lyons in September. So what does this actually mean?
It's a pivotal moment. The guidance they've set up for Lyons is incredibly specific. For full year 2026, they are projecting revenue growth of 3.5 to 4%, but they are keeping expense growth to a strict roughly 1.75%.
That's very tight needle to thread.
Extremely tight. And their ultimate target is reaching a 15% ROTCE return on tangible common equity by 2027.
Okay, so when a new CEO steps into a bank that is already firing on all cylinders, beating EPS, raising guidance, is his job just, don't mess it up? Or is there a specific heavy mandate hidden inside those ROTCE targets?
Oh, it's definitely not a maintenance job. According to the strategic outlook, his mandate is aggressive execution. ROTCE strips out all the intangible fluff. It's pure operating profit against hard capital. To hit 15% by 2027, he has to hold the line on expenses.
Right, that 1.75%.
Exactly, which is often lower than inflation. So that requires real operational discipline. while simultaneously pushing that top-line revenue up.
Yeah.
He basically needs to squeeze maximum efficiency out of all those massive tech investments we just talked about.
Right. Those 167 million AI insights have to actually translate into sold products and higher advisory fees.
Precisely. The board built a Ferrari, and now they are handing Lyons the keys and telling him to win the race without burning out the engine.
Man, that is quite the task. So, to summarize this deep dive for everyone listening, Truist isn't just sitting on deposits like a traditional vault anymore. They are aggressively returning capital, utilizing a massive digital infrastructure. They're seeing strong credit health across the board, and they're orchestrating a very calculated transition of leadership. Understanding this shows you exactly how regional banks are adapting to survive and really thrive right now.
Absolutely. And if I could leave you with one final kind of provocative thought based on what we've seen today.
Yeah, go for it.
We talked about Truist generating 167 million personalized digital insights this quarter. If a bank's algorithm knows more about your daily spending habits, your upcoming bills, and your financial anxieties than you do.
Which it probably does, honestly.
Right. At what point does the bank transition from being a passive vault that holds your money to an active platform that shapes your entire financial life?
Wow.
The differentiator won't be branch locations anymore. It will be data privacy and trust. Something for you to mull over as these systems get even smarter.
That is a really great point to end on. Well, that wraps up today's deep dive. Make sure to follow the show for our daily earnings coverage, and we will catch you on the next one.